Thank you very much, Cindy. It's a pleasure to be here today and see everyone out on this wonderful Sunday morning. Really quick background on myself. I've been at Centurion just over 9.5 years, and prior to that, ETF world and mutual fund world. So it's been a real pleasure. I joined Centurion when it was 600 million in assets under management. Now we're about 7 billion. I'm having issues moving these slides around. I'm not the tech guy at Centurion, don't worry about that.
I'm not the tech guy either, so.
I will just quick, oh, there you go. Also there. Quick background on Centurion. It was initially launched by a gentleman by the name of Greg Romant. Prior to Centurion, he was a derivatives trader. Tremendous career. Worked in first Toronto, New York, London, Hong Kong, Singapore. Finally, where he was head of emerging markets derivatives, head of risk for EIG in Singapore. I just highlight that because his background into capital markets is tremendous. But as a derivatives trader, your focus is working with your clients to minimize risk, see what the risk is, minimize it, mitigate that. And he's done that. So he did that extremely successfully in his capital markets career. But he's brought that very much that same mentality to Centurion. First and foremost, protect investors' capital, give you some income, and give you some appreciation on top of that. And I'll say, you see, the company's done extremely well. We've continued to grow over the years. You can see here, he's done that with the returns for investors as well. The annualized return since inception in August of 2009 has been 12.84%. I like to say this fund is nice and boring. One of those things you probably forget about it, but it will consistently provide some very attractive returns for you as the investor, with none of the excitement of the stock market. And just like to point out a few years in this, 2017 to 2019, very strong years. Obviously, this year was increasing demand, lack of supply. Can't guarantee any forward returns, obviously, but we're very much in that same type of situation right now here in Canada. I'll show you some slides on that. When I talk about risk management, as I look at the first COVID year of 2020, when we returned 7.93%. A year of uncertainty, to say the least. We managed that extremely well. We'll just say management approach again is always protect investors, give you some income, then give you some growth on top of that. That approach, that long-term approach, has really rewarded yourselves, rewarded people who've invested with Centurion. When I talk about volatility in the public markets, you can see this, the yellow highlight is the Centurion Apartment REIT since inception. Public markets can give you a lot of good upside, they can take that away. I've tried to trade it, not so successfully, but it's a tough place to be. I like having something nice and boring in a market that makes sense. Multi-residential in Canada makes a lot of sense, and I'll show you why. One, no surprise to anyone, especially here in Vancouver, real unaffordability of housing. Extremely, you can see here the median income needed in Vancouver to actually realistically own a house is 93%. Toronto, almost 80%. Extremely unaffordable, no surprise there. And you can see this is really being reflected in what we see in the housing market in Canada. Far more renters. Far more people are forced to be renters in Canada. I think there's going to be a realization that there are going to be renters for a lot longer. If they'll never rent. Maybe they'll always be renting the rental market. So that market is increasing demand. You can see here, obviously, we talk about strong immigration. There's really population growth. Canada's population growth is by far the fastest in the G7. I think it's number 4 in the G20. Obviously, a lot of that does come from immigration. We're a big country, we have the space, but one thing we don't do is we don't build very fast. And in Canada, I'll say this, I'll give you a quick comparison. I mentioned we have 4 properties in the US. I'll just give you a quick comparison when I say we don't build very fast. The property we had in Texas was, the developer bought the land, closed on that land 2 months later. And then permits were ready to go, get building. The whole start to finish, less than 2 years. In Toronto, if you're looking, I'll say GTA, I'll say Ontario. If you buy the land, you can still close on it 2 months later. But if you start digging before, within 2 years, you're lucky. More likely 3 years if we can actually start construction. And then sometimes longer. So when I say we don't do things very fast, we don't. There's a lot of red tape to get through before you can actually start digging. And what's especially now, and what that means is with rising costs, a lot of projects aren't as feasible as they used to be. So we're going to see less supply when we need more supply coming online. And here, this is where we stand in the rental market in Canada. We're at multi-decade lows on the vacancy rate. Again, tremendous demand. People need housing, obviously. and they're going to the rental market. And the rental market, the development side of it, we got great developers in Canada, but we can't keep up. There's not enough ability to, get ahead of this. And that's why I referenced that Texas example, where you see people who say somewhere like Texas, rents go up, developers show up, and they balance the market out, and the market comes down a little bit. The mechanism isn't going to happen in Canada. So we're going to have very strong rental markets. We're going to have very low very low vacancy rates here in Canada going forward. And this again just touches on the unaffordability that we're seeing. Again, Vancouver nicely in third place in the world, Toronto number 10. So we're trying to catch up, but we're not quite there. And this, I think it really puts a little more detail on that, where you can see, the baby blue dot is mortgage payments as a percentage of your income. And you can see in Ontario, that's going to be about 80%. Obviously in Vancouver, it's going to be about 93%. You're just going to median income, median house prices. So people are consistently going to be house rich, cash poor. It's going to be a situation that people don't want to necessarily be in, and they're going to be forced into the rental market. And I'll say this, in our portfolio, we're comfortably middle, I'd say B type of buildings, not high end. And I'll use a Toronto example, but Yorkville, extremely expensive. Those are Class A type of buildings, very high end. At the same time, I'll say demanding tenants. We're in that B market, B plus to B minus, and middle income type of buildings that look like condos. Some nice amenities, but again, not high end. And what we're seeing is, and this has started about a year ago, is some of the most highly qualified financially tenants coming into our buildings. This is really a reflection of housing's not affordable. They had the income, which in a few years ago would have meant they could have bought a home, but they can't do it anymore. Their credit scores are great. Their income is at at a good level, and they can't get into the housing market. So we're really starting to see that, and that may continue to, I'll say, increase going forward as people either obviously continue to not be able to afford to buy, but at the same time, we're seeing a bit of this. I'll talk to the GTA, where people are looking at their mortgage payments and they know it's not affordable. So they're going to maybe sell to get ahead of what could be a big selling event in the markets. As we see, obviously, variable rates have gone up. We could see, resets on fixed in next year and the following. So we are seeing more and more people come into our units that obviously should be able to buy, but also are starting to sell just to get ahead of that. And then when we talk about population growth, you can see there's a bit of a spike on the far end of that. And when we talk about population growth, and we do talk about immigration, again, great for the country, big country, a lot of space. We need the people coming in, keep the population younger, but we don't have facilities. We're here to talk about housing, but we don't have the ability to build enough. And we're going to continue to see that being an increasing issue going forward. And when we talk about immigration as well, it's, it's 430 came last year, 450 this year, maybe close to 500,000 next year. That doesn't factor in the temporary workers that are coming to Canada. That doesn't factor in all the international students that are here in Canada. So we're talking over 1 million people come to the country every year. And again, we don't have the housing for that. I was thinking to say one question I do get is, well, where does everyone live? You start seeing, multi-generational families living together. You see, not related families living together. And I've seen this in Toronto, where, and I have a friend who does inspections, and there's undesirable living standards in certain circumstances. So people are forced to go into housing that's not ideal. I'll say that. So we're going to see that increasing demand and increasing demand for housing. And this just puts a few more numbers on the immigration numbers there, or a few more detail on the immigration numbers. And it's going to continue. And I'll say this, even if immigration was cut in half or stopped right now, which I don't think is feasible in Canada, but the same zero immigration for the following 3 or 4 years, we would still be undersupplied. It would take us quite a while, probably the end of the decade, to really get ahead of that. So it is an issue. When we talk about a housing issue, it is a real issue. The demand is outstripping supply consistently, pushing prices up. And I'll come back to this, is we talk about the issues with supply, and this really relates to what's going to be increasingly a bigger and bigger issue is, we talk about shortage of construction workers, increasingly retiring. We have a lack of skilled labor to really build everything that we need to have built, but the cost of everything has gone up as well. So what we're seeing, and we do have some lending, about 6% of our portfolio is lending to developers. We're seeing more and more projects come to us that just don't make sense. The numbers don't work anymore. The cost of everything has gone up. Drywallers, you know, the GTA now can make over $200,000 a year. The cost of labor has gone up, concrete, rebar, and financing. Like the financing we used to do with developers, our average interest rate we would charge on the debt we were lending was 9%. Now it's about 12.7%. We're talking, you know, 50, 60, $70 million. That's material. We're seeing a lot less projects that are actually feasible. There's great developers out there, and they're doing this, they're obviously still building, but we're going to see less and less supply. We saw this last year in Ontario, GTA, where, you know, a lot of condo projects, you know, unless they really get their pre-sales going and then they get the financing and start building, they don't work. So we saw about 10,000 units worth of projects canceled last year in the GTA, and we'll probably see something similar this year as well. Those are people who thought they bought with prices about 4 years ago. Now they're not getting the home they thought. Now they're in a very, very different market, and they can't afford to buy. They're going to be forced into the rental market as well. So it is going to be a chronic issue going forward. There's no easy solution to expanding the supply here in Canada. It's just not something that's going to happen overnight. And here you can see what that leads to. Here in Ontario, we're going to be, you know, by 2030, we're going to have a shortfall of about 1.5 million housing units. It's going to be a serious issue. And obviously in Quebec, it's going to be just over 800,000. Here in Vancouver, or British Columbia, just over 600,000. That's a meaningful shortfall in housing. And if you look where immigration goes, and I'll talk 2022 annual numbers, 227,000 of the immigrants that came to Canada moved to Ontario. And then you can see for Quebec, it was about 80,000 of the immigrants that came to Canada stayed in Quebec. And then it was about 68,000 of them came to BC. So, I mean, the demand is coming to places that are going to have a chronic shortfall. And I do point out, this is where we have most of our buildings. In Ontario is about 40% of our portfolio in the GTA, Southwestern Ontario. Then second is Quebec. We have about 20, 25, and then we have about 20% here in BC. So we'll say with Centurion, we're focused to want to be where, you know, people where they're coming to, where people are going to be living, where the demand is going to be the strongest over the next few years, or probably a lot more than the next few years. And this gives you a few more details on that. I know this is all very rosy projections, and I'm usually not so much of a downer, but I think it's just interesting or important to understand that we are going to be chronically undersupplied on the housing side. I'll just touch the top bullet point there. Really is, you know, these are projections from 2021. The federal government and CMHC said we were on track to have it build about 2.25 million dwellings, everything from condos, townhomes to single-family homes, whatever it is. So from 2021 to 2030, we're going to build about 2.25 million. And their estimate was for housing to at least be affordable, we had to build 3.5 million more on top of that. I like to say in the investment industry, nothing's guaranteed, returns aren't guaranteed, past returns no reflection of the future, but who here thinks we're actually going to build that extra 3.5 million dwellings? No one ever says yes. But I just think it's not going to happen. But again, I think we have great developers, people looking to build as much as they can, but it's just not feasible in this very high cost environment. And again, with demand consistently outstripping supply in the marketplace there. So we're going to be chronically undersupplied on the housing side. And obviously we get this question more as more governments, you know, removing the GST from development projects, or governments trying to, you know, reduce regulations. I mean, the GST is maybe it makes a few more projects feasible. Maybe. All the other things, everything in place to, you know, ensure there's a lot of red tape. I don't see that going away, but it'd be ideal in a, you know, greater world if we could actually build things a lot faster, but it's hard to see that changing anytime soon here in Canada. So here's the portfolio for Centurion. It is focused on Canada. I got 155 buildings, 151 are in Canada. And I'll break it down this way. In Canada, in Ontario and BC, we're only in the primary and secondary cities. So this simply meaning in Ontario, we're obviously in the GTA, we're not downtown Toronto, that's not our market. We're in the GTA like Scarborough and Etobicoke, Southwest Ontario, a bit up in the Ottawa area. Same thing for BC. We're not downtown Vancouver, that's not our market. where we are out in Surrey or up at Burnaby on the island. Again, we're not downtown prices. That's not what we're going to focus on. Our focus is kind of nice B-class new builds for, huge potential, middle income type of potential tenant base. And we're seeing that. I'll say with that approach, and rest of the country, primary cities. We're just, even in Quebec, the largest rental market in Canada, we're just in Quebec City and predominantly just in Montreal. And this focus on being where people are moving to has, reflected obviously some very strong returns for the portfolio for investors. But it simply means our stabilized occupancy rate is over 98%, about 98.5%. And our overall portfolio occupancy rate is about 96.2%. The difference between those two is when we buy a building, it can take 1 to 2 years to stabilize it. Simply meaning new acquisitions, they have to be leased up. Usually takes 1 to 2 years to get it operating where we think it should be. When we buy a building, we have a forecast, we have expectations of what we can do. It usually takes 1 to 2 years, depending on the building, the size of it, what investments need to be done to get it operating the way it should be. So I like to say the stabilized occupancy rate is a great forecast of how we operate, great understanding of how we operate over the long term. And I will say this, operationally, we do everything in-house. We run the buildings ourselves. We have superintendents living in all the buildings, which I think is very important. We do take the operations side of the business very, 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 it's a big thing for us. It's very important. Do things well, do it the Centurion way. Make sure they're safe, make sure there's good tenants in the buildings, make sure it's clean, make sure it's efficient, make sure it's well run, make sure the tenants obviously pay their rent as well. Let's just touch on one thing, is we do have some student housing, 16 buildings. That's been a nice little diversifier. It's about 10% of the portfolio. That's 100% occupied for us right now. And we do have some medical offices in there as well. We see medical offices, and I would say that was more of a one-time acquisition. We do see medical offices really the same way as housing in Canada. I'll speak to Ontario on this. We need as much healthcare as we can possibly get. We're chronically undersupplied there as well. So we saw a great opportunity to make some acquisitions in that space. And we got it, I would say, at an extremely attractive price. There's a very motivated seller on the other side. So when I stress this, with this medical offices, we have 10 of them. It's a little portfolio. We own 75%. And we have an operating partner who owns 25%. We'll say we know how to run apartment buildings. We know how to run student housing. That's our bread and butter. But on the medical office side, we do have a third party who has a significant stake in it that runs the day-to-day, that does the day-to-day operations for us. So we know what we do well, and where when we're not the experts, we do get the experts to come in and do it for us. The next few slides are just going to highlight some of our more recent acquisitions. We do have a few buildings in Calgary. This is our third. Again, nice new builds, some nice amenities, but again, kind of middle income focused. It's a little bit removed from the downtown core. Here's another building we have up in Kelowna. This, I believe, is phase 2 of a 3-phase portfolio. We like Kelowna. I like Kelowna quite a bit. It's a nice city for us. It's done very well. Whenever I go to Kelowna, all I hear from the advisors there are, too many people moving here. Tell them to stop. So it is a great place to live. But again, you can kind of see it is very much focused on that middle income type of building with the amenities, but with the rent that's at the right price point. So again, all these buildings, by making new acquisitions are stabilized in 1 or 2 years at the latest if it's a really big project. But no, these new buildings we're getting are doing very well for us. And this is just a great example of, one of our student housing. Now we do talk about, we don't do downtown, especially downtown Toronto or downtown Vancouver, but this is one of the student housing properties we just acquired. And this is right downtown. This is near Ryerson, which is now Metropolitan University. So this is student housing. It's right where the students are going to live because they're going to the university. So for this was a great acquisition, but not reflective of the type of buildings we're going to be acquiring. This is not downtown. I stress that just because the price points there are very different. And I'll say we also saw downtown, I'll speak to Toronto, is during COVID, people were paying top dollar, like the 1-bedrooms, very small 1-bedrooms are starting at 24, 25, probably 2,500, easily up to 35, up to 4,000 if you want to live the good life. It's an expensive market. So things have to be going really quite well for people to want to afford that. We saw when things shut down, people didn't have to pay that price, they left. Our focus is obviously removed from the core, middle income type of buildings. I've said that a lot today, but that's our focus. And it was far more resilient. And I'll say this, during the whole COVID issue, that focus really rewarded the portfolio and investors. Zero issue on rent collections, on performance, operations, all went extremely well for us. But I do stress that, like that focused in the large population centers around Canada on the middle income tenants is doing extremely well for us. And it just gives you a bit of a detail on the breakdown of where we are or where the portfolio is allocated. It is interesting, kind of touched on this a little bit, but on the lending side, that is, I think the smallest as a percentage, it's been the smallest it's been in a long time, and as a dollar value, it's just over 350 million, which is the smallest it's been in quite a long time as well. We see a lot of deals that don't make sense for us. Just the numbers don't work anymore especially at these high cost of debt, high cost of everything else. So we are being very prudent, but we still do see some good opportunities out there that helps build a pipeline of acquisitions for us. When we lend to a developer, the idea is, we have the right of first refusal when that project's completed. So that does help us get the type of projects, type of developments we want in our portfolio. And here's a quick recap is obviously we want to give you some monthly income, very tax efficient monthly income with some appreciation on top of that. But I will stress is that Centurion, we have, I'll say, best practices on the oversight. We are a private company, so we, trade monthly, if you will. We have monthly liquidity. But for us is we want to have all the best practices you would want to see as an investor. So you can go to our website, you can look at our audited financial statements, our own operating memorandum, but I'll say on the valuation side as well. We use a third-party independent appraiser to value every building every quarter. So we do this obviously 4 times a year. So they bring the market data to the table, and then they sit down with our finance team who has the income side of it. They put the numbers together, then they determine if there's going to be an increase or not. So I think a very, very thorough vetting process, also with that annual audit from KPMG. But KPMG also brings in the real estate valuations team as well. And they go through every one of those quarterly valuations. They go through every one of the 155 buildings that were valued and make sure what's being given to us actually makes sense. I just want to highlight that is oversight is second to none. And again, you can go to our website. All of this is fully available for any investor. Sorry.